We have seen the dollar retracing some of yesterday's strong gains, but really quite a sharp reaction to that news from the Bank of China that they are raising interest rates by 25 basis points.
Hi, good afternoon, Stephen. Yeah, exactly that. Well, People's Bank of China coming out with a surprise hike of 25 basis points, as you say, markets reacting to that. If we look at it from both sides, the motivation to do that, we've spoken about China being concerned that their economy is overheating, and I think one of the main motives there was to avoid any sort of asset price bubble, and with particular concern about the housing market and prices taking off there, and obviously the sort of social ramifications that has. So I think from a justification point of view, that was certainly the right thing to do from their point of view. But the world, obviously, the major concern is that, you know, if there is any slowdown there, how does that affect demand for commodities worldwide? Steel, certainly in the housing market, as Eleni mentioned earlier, those housing stocks taking a little bit of a battering yesterday. Obviously, that's where the concern is for demand over steel and other commodities as well. So that reflects right the way through to commodity currencies like our own. So we saw the rand moving a lot weaker yesterday, and at the moment obviously consolidating.
And do you think this has been an overreaction though, James, because we are getting third quarter growth figures out of China tomorrow, and they're expected to show growth of around 9.5%, down from 10.3% in the second quarter. So this is an economy that's still growing at really fast rates at this stage.
That's it. We've seen a retracement from those initial shock effects, that's right. And still with growth up in the 9% region, I mean, that's still fantastic. So it is probably an overreaction, but you know, that is what it is.
Well, of course, we mentioned those housing stocks, but how about the housing starts yesterday? Because the market seemed to read them as quite positive, didn't it?
Yeah, it's a positive move up from, I mean, up to the sort of 600,000 level. But, you know, if you look at it in context of the sort of average level of new housing starts, going back to the 80s right the way through to about 2005, they were averaging around 1.5 million per month. So that's dropped down to lows of just above 500,000 and recovering to 600,000. Sure, it's a recovery, but it's not recovering to anywhere near the sort of average levels of a performing economy. So it may show, you know, a little bit of encouragement, but it certainly is indicating the real goings on in the economy and what the consumer's doing. With high levels of unemployment in the States, you're finding a lot of debt repayment as opposed to new housing applications. So that's probably the main concern, is it goes back to unemployment levels, and it goes back to a struggling economy in the States still for some time.
James, do you think it adds to the case for more quantitative easing at this stage? Because it looks like there's also a bit of a trade-off between the US and China, really on the quantitative easing versus raising interest rates in China at this stage.
Yeah, that's it. I mean, all indications at the moment are that quantitative easing too will go forward. It has been mentioned by Mr. Bernanke. There was also another Fed official yesterday that was saying if it is to go ahead, that it should be, you know, of a reasonable proportion or a large size to have some effect. So all indications are that it will go ahead, and obviously the market is looking out for timing and size of that.
And of course, the extent of that will really determine where the dollar goes from here. And of course, we had Brazil yesterday raising that tax on portfolio inflows on its bond market from 4% to 6%. So more countries really coming to the fore with attempts to try and weaken their currencies.
That's it. It's been on everyone's minds and lips that for the last month or so, the currency war, and, you know, economies weakening their currency, trying to sort of benefit from exports. And Brazil, a good case, you know, the flows that they're experiencing, not unlike our own, you know, foreign funds seeking higher yields. And as far as we've seen, I mean, the taxes that they've imposed haven't necessarily helped. So I think that's, you know, it's probably a good indication as to what our policy around those sort of inflow taxes will ultimately be. You know, if it's not going to work, it is a difficult thing to impose. So you know, we've got our own issues with regards to the currency here, and I suspect, you know, if anything, we'll hear some more comments and plans about what the government intends to do in that regard next week at the midterm budget statement.
Of course, we did have Finance Minister Pravin Gordhan speaking yesterday and warning against these competitive devaluations of currencies. So it looks really like South Africa's not going to go that route at this stage.
Yeah, it's a good point. I suppose you can't sort of put conditions and concessions in when it suits you and remove them at another point. You really, you know, in Mr. Gordhan's opinion, need to let the market really react freely. So it's probably a wise comments from him. We also had Central Bank Governor Jill Marcus speaking yesterday and referring to extraordinary times, call for extraordinary measures. So it will be interesting to see how that will eventually take fold. It didn't seem to be referring in any way to monetary policy, as her comments certainly were saying that our interest rate level will remain accommodative for some time going forward. So no real hint there of any move lower in interest rates per se, but perhaps confirming or leaving at least the door open in that respect. So I guess that statement is, with regards to extraordinary measures, probably refers to some form of exchange control, or perhaps some sort of tax rebate for exporters, more likely.
How have government bonds been reacting throughout all of this, James?
It's been a relatively active week, but with regards to price action, but no real sort of foreign demand as such. So we've seen the 157 yields move from around the sort of 7.17 levels down to just above 7%, and now back in the sort of middle, perhaps around the 7.11 level as we speak. So there has certainly been a lot of trading and price action, but it's not been one way, certainly not.
How about the shorter end of the curve? What's that telling us about interest rates at this stage? Because, of course, we have had some disappointing numbers out, particularly in the retail sector and the manufacturing sector over the past couple of weeks.
Yeah, that's right. With reference to manufacturing, of course, we saw the short end sort of FRA market tending to discount more chances of a cut in the cycle than it was, getting to sort of extremes of around 70% chance of a 50 basis point cut happening at some point next year. Given, I think, sort of the comments from Ms. Marcus yesterday, perhaps the market expecting a little bit more to come from that, and we've retraced a little bit, but still discounting around the 60%, 60 to 65% chance in the cycle. So, you know, it's still there for the time being. The timing remains weighted more likely towards a move next year, if anything. But I think more importantly, next week's a big week for data, and we'll be looking at the inflation, and any surprise there will ultimately seal the November MPC's fate, you must think.